We now move on to reading 29 of the CFA curriculum, which deals with the accounting for inventories. So we'll start with an introduction to what inventory is, the methods of costing and valuation, the difference in accounting between periodic and perpetual inventory, comparison between LIFO and FIFO cost flow methods, accounting guidelines for writing down and subsequently writing up inventories, disclosures required, and wind up with the concept of LIFO reserve. Now, for merchandising firms or trading firms, inventory is always normally ready for sale. That is, we purchase material and distribute it forward. For manufacturing firms, inventory could either be raw materials that have not yet been processed, or work in progress, also known as semi-finished goods, or finished product that is yet to be sold. Please note that inventory is a balance sheet item. The corresponding item in the income statement is called cost of goods sold. So cost of goods sold is normally the raw material expense for the revenues recognized. The COGS can be calculated as the beginning inventory. So we assumed that we first sell what is left over from last time, plus whatever we purchased new in this accounting period, minus whatever we have been unable to sell, or ending inventory. So beginning inventory plus purchases minus ending inventory is what we sold in this period. We can rewrite this equation in many ways. So purchases can be thought of as ending inventory minus beginning inventory plus the cost of goods sold. Likewise, we can calculate the beginning inventory or the ending inventory from the same equation. Like most balance sheet items, inventory is normally carried at cost. So let's assume that we have a pen manufacturing plant and the capacity of the plant is 10 pens per year. The fixed costs in the plant, so these costs are independent of the number of pens produced. They are like rent, electricity, municipal taxes, etc., are to the tune of $100 per year. The variable cost, or the raw material and processing charges for each pen, are to the tune of $10 per pen. So if you produce 10 pens in a year, what will be the cost of producing the pen, or the per unit cost of inventory? So we produced 10 pens. There will be a variable cost of 10 into 10, $100, and fixed costs of another $100, giving me a per pen cost of $20. Now let's assume that in the same example, we produced only one pen in the year. So even though we did have a capacity of 10 pens, for some reason we could manufacture only one pen in this year. Now in this case, what would be the inventory cost? Would it still be $20 or would it be slightly different? So I produced one pen. The raw material cost and processing for one pen would only be to the tune of $10, and I would be spending the entire $100 because these expenses remain fixed. Now please note that just because I was unable to work at full capacity this year does not mean that the value of my pens has gone up, or anybody in the market would be willing to pay me extra because the cost of producing the pen has been additional. So remember that wasteful expenditures, or the unallocated portion of the fixed costs, cannot be loaded onto inventory. So even though we may have spent $100 this year, we would be allowed to ascribe only the allocatable portion of this fixed cost to this one pen. So $100 was the cost attributable to 10 pens. So for one pen, only 1/10 of this cost will be attributable, or the cost of my inventory will still be $20. So please remember that in calculating the cost of the inventory, the following product costs are allowed to be capitalized. So these are the raw material costs, or the purchase cost, the conversion cost required to convert the raw material into the finished product, allocation of fixed production overhead based on normal capacity levels. So in the earlier example, remember, $10 can be loaded onto one pen, but I cannot load the entire $100 onto just one pen if I'm manufacturing 1/10 of my normal capacity. Other costs that are necessary to bring the inventory to its present location and condition A very common expense here is called freight inwards. That is the freight required as a part of the production process. So I need to carry material from the mine to my plant, and it has to be transported within the plant in various processes. So that freight can be loaded onto the cost of inventory. The other set of costs are called period costs, and these are not allowed to be capitalized to the cost of inventory. Rather, they need to be expensed as they are incurred. These include the unallocated portion of the fixed production overhead, that is $90 in case of the second example we did earlier. Any abnormal waste of materials, labor, or overheads cannot be attributed to the inventory. Storage costs over and above the production process cannot be capitalized. So if they're required as a part of the production process, they'll be included in these other costs. Otherwise, they need to be expensed when incurred. Any administrative overhead, so the CEO's salary cannot be loaded onto the cost of inventory. The HR department salary cannot be loaded on. Yes, the labor's wages can be loaded onto inventory, but not the administrative overhead. Any commission or advertising, marketing expenses that we are making cannot be loaded onto the cost of inventory. So let's do an example and understand better. Wango Company manufactures a single product. The following information has been taken from the company's production and cost records for last year. So normal production capacity is 10 million units. In this period, they produced 4 million units. The conversion cost is given, raw materials, fixed overheads, freight inwards is mentioned, storage cost for finished goods, and the abnormal waste. Assuming no units remain unfinished at year end, calculate the capital cost of 1 unit. So we'll apply the same concept we just studied. So the total production has been 4 million units. Conversion cost for finished goods would be included or capitalized in the cost of inventory. Likewise, the cost of raw materials, that is $70 million. Fixed overheads, only to the extent allocatable, will be allowed to be included. So $12 million is for the production of 10 million units. So how much of this would be allocatable to 4 million units? That will be 4 by 10 of the 12 million. Freight inwards, like we discussed, is the freight required as a part of the production process. So this will be added. But please note that the storage cost for finished goods cannot be added to the cost of inventory, and likewise the abnormal waste. This calculation will give us the cost of inventory as 10 plus 70 plus 4.8 plus 1.6 divided by 4 million units. That is equal to $21.6. So that was about computing the cost of inventory. Now let's assume that I'm an oil marketing company. That is, I purchase oil at different points in time and I sell it to my consumers. So I've been purchasing oil every day at different prices. Some oil was purchased at $98, some at $100, some at $92.6, so on and so forth. Now, do you think I'll have one big container in which I'll be storing all the oil, or for every day that I'm purchasing, I'll store my oil in a separate container? Yeah, it makes sense to put it all together since the oil is the same. Now, if a consumer comes to me and asks for 1 barrel of oil, he's willing to pay me the market price for the oil, but he says that I want to buy the oil that we purchased for $95. So will I be able to give him the oil that I exactly purchased for $95? It'll be difficult since it's all an emulsion now. So I'm just going to tell the client that all oil is the same, and you should be worried about the current market price. It doesn't make any difference to you what price I purchased the oil for. So let's say that he does purchase the oil at the market price, which is $110, and you complete the sale. Now, when you are creating your income statement, you yourself are faced with the same dilemma as to what should be the cost of goods sold for this oil that you've just sold, because you yourself don't know that which oil have you actually sold. So in this case, the cost of goods sold is an assumption, and so is the ending inventory, that is remaining after the goods in your container. So there are three broad assumptions that are allowed. We studied these in the income statement as well. LIFO stands for last in, first out. That is, the oil purchased last will be assumed to be sold first. FIFO assumes that the oil purchased first was the first to be sold. Weighted average cost assumes that all oil sold was at the weighted average cost and what is remaining is also at the weighted average cost. In the specific identification method, this is normally done for high value items like jewelry, etc. I actually keep each of these items purchased in a separate container so that I know the cost of each and I can specifically recognize the cost as the sale is completed. So in specific identification, each unit sold is accounted for its own cost. So IFRS allows us to use the specific identification method, the first in, first out method, and the weighted average cost method. US GAAP allows us to use all these three methods, plus also the last in, first out method, which is not allowed under IFRS. Once again, FIFO assumes that items purchased first are the first to be sold. So cost of goods sold would consist of the items purchased first, and the ending inventory would consist of the items purchased last or the most recent purchases. LIFO allowed under US GAAP assumes that the items purchased last are the first to be sold. So COGS in the income statement would consist of the last purchased goods and the ending inventory would consist of the earlier purchases. Weighted average cost assumes that items sold are a mix of purchases. So the cost of goods sold and ending inventory would both be the weighted average cost of all items. So let's do an example. Use the inventory data in the following figure to calculate the cost of goods sold and ending inventory under the FIFO, LIFO, and weighted average cost methods. So in the month of April, we purchased 15 units as described and we sold 10 units. So the ending inventory consists of 5 units. Our job is to put a value to the cost of goods sold and the ending inventory using each of these assumptions. So let's first do the first in, first out. So in this, we will assume that these 10 units sold were the first 10 units that were purchased. That is, these 5 units bought for $1 a unit, or a total of $5. 4 of these units bought at $2, or a total of $8. And 1 out of these 6 units, which was bought at $3 per unit. So the total cost of goods sold would be 5 plus 8 plus 3, that is $16. The ending inventory consists of 5 units and all these 5 units were purchased at $3 per unit, giving us an ending inventory number of $15. In the last in, first out method, we will assume that the 10 units purchased last were the first to be sold. So all these 6 units are out and all these 4 units purchased at $2 per unit are also out, making a total of 10 units. So the cost of goods sold would be $18 plus $8, that is $26. And the ending inventory consists of the 5 units that were purchased first at $1 per unit, that is $5. In the weighted average cost method, we will first compute the weighted average cost of inventory. So we have 15 units bought at a total price of $31, implying a weighted average price for each unit of $2.07. So the 10 units sold would be assumed to be at this weighted average cost. So it will be 2.07 into 10, that is $20.7. And the ending inventory would consist of 5 units, also at the same cost, giving a total of $10.3. So please note that the cost of goods sold plus ending inventory is the same, that is $31 under all methods. However, the calculation of the COGS and ending inventory will change depending on the assumption. So what we just studied was an example of periodic inventory, which assumes that inventory is valued only once at the end of period. So at the end of April, we valued the inventory. In a perpetual inventory system, inventory is valued more than once. That is, it can be valued in the middle of the period, or theoretically it can even be valued every day. So let's take an example and understand the concept. So assume that the purchases and sales exactly occurred as follows. So on April 1st, we purchased 5 units at $1 per unit. On April 10th, we purchased 4 units at $2. And on April 15th, we sold 6 units. On April 20th, purchased another 6 units at $3. And on April 30th, sold 4 units, making a total of 10 units of sales during April. So recalculate the COGS and ending inventory under the FIFO and LIFO cost flow methods. So I'll do it using the LIFO method. Please calculate using FIFO on your own and verify the answer. So if you assume the last in first out, then the first valuation is happening on April 15th. So we're assuming a perpetual inventory system in this question, and the inventory is being valued twice, first at the end of April 15th and then at the end of April 30th. So in the LIFO, the 6 units purchased last would be assumed to be the first ones sold. So 4 of these units would be sold, and 2 out of these 5 units would be assumed to be sold. So the cost of goods sold for the first 15 days would be 4 into 2, $8, plus 2 into 1, $2, that is $10. The ending inventory going into April 16th would be 3 units purchased at $1 per unit, that is $3. Now on April 30th, when we value the inventory, we see that 4 additional units have been sold. Using the last in first out approach, we would assume that 4 of these 6 units have been sold at $3 per unit. So the cost of goods sold would be $12 per unit, and the ending inventory incrementally would be 2 units purchased at $3, that is $6, plus the carry forward inventory from April 15th, that is $3. So total $9 of inventory would be left at the end of April 30th, and the total COGS for the month of April would be $10 plus $12, that is $22. Please recall that using the periodic inventory method, that is if we valued the inventory just on April 30th and no valuation was done on April 15th, the same calculation was $26 for the cost of goods sold and $5 for the ending inventory using the periodic method. Please verify that if you use the first in first out method, the answer would have been the same as that of the periodic. So there would be no difference between the perpetual and the periodic inventory as we saw in the LIFO if we had used the FIFO method. So in the FIFO, our cost of goods sold would have been $16, ending inventory would have been $15. In the LIFO method, as we calculated, the cost of goods sold would be $22 and the ending inventory would be $9. So we see that the FIFO calculation is the same for the periodic and perpetual, whereas the LIFO differs, as we just checked. So let's see what impact would the choice of inventory method have on the income statement and the balance sheet. And the assumption here is that prices are rising. So we are in an inflationary environment and inventories are stable or increasing. So the first item we'll discuss is the cost of goods sold. In the LIFO method, the last in is the first out. So the more expensive goods would be sold first because prices are rising, or the cost of goods sold would be higher than the FIFO method. If the cost of goods sold is higher, the net income, both profit before tax and profit after tax, even the EBIT would be lower because of the higher COGS as compared to the FIFO method. Lower profit before tax would also imply lower tax outgo for the LIFO method, as if you're showing less profit, you'll have to pay less taxes as compared to FIFO. Now in the LIFO method, the last in, that is the expensive inventory, is first to be sold. So the remaining inventory will be at the earlier prices or the cheaper rates. So the inventory balance or the ending inventory would be lower in the LIFO method and higher in the FIFO. As far as working capital is concerned, current liabilities are not affected. So your payables and debt will remain the same. However, current assets will be lower in LIFO because the inventory balance is lower. So the working capital would be lower in the LIFO method as compared to the FIFO. Now the choice of inventory cost flow method generally does not impact cash flows. That is, sale and purchase of goods will carry on whether we use the LIFO or the FIFO method, so cash is not affected. However, to the extent that LIFO shows a lower net income and thereby a lower tax outgo, which is a cash outflow, ensues in the LIFO method, cash flows will be higher in the LIFO method. Will not be a significant difference, only to the extent of the lower taxes paid. Everything else remains the same. Please note, if we change this assumption to declining prices, then all the answers would reverse. Please think about each item just as we did for rising prices on your own in case of declining prices. So we can verify our answer. We next study the very important concept of inventory write-down. So let's go back to the example that we studied in the beginning, wherein each pen cost $20. Now let's assume that there are competing pens in the market and the true worth of my pen, even though the cost of manufacturing this pen was $20, the fair value today is only $10. If I keep the 10 pens in my inventory at a value of $20, that is, I'm showing an ending inventory of $200, am I to an extent misrepresenting the assets on my balance sheet? My shareholders will get a sense that there is $200 worth of inventory which will probably be sold at a higher price, which I know is actually not the case because the inventory has fallen in value for whatsoever reason. In cases like these, it is prudent to take an inventory write down, that is, recognize an upfront loss and write down the value of the inventory from $20 to $10. So let's see what the accounting guidelines exactly say about this. According to IFRS, inventory must be carried at lower of cost or net realizable value. What is net realizable value? It is the selling price minus any commissions or selling costs that we need to incur. If the cost of inventory is higher than the net realizable value, then inventory must be written down to the net realizable value. In this case, let's say $10. That is what I can realize today. And correspondingly, a loss must be booked in the income statement. US GAAP says that inventory must be carried at the lower of cost or market. And how is market defined? So market is equal to the replacement cost, that is how much it would cost for me to replace the inventory in my godowns today. However, market must be between the net realizable value and the net realizable value minus a normal profit margin. So we'll explain this better with an example. Sony Incorporated sells digital cameras, and the per unit cost information pertaining to Sony's inventory is as follows. The original cost of the inventory is $500. The estimated selling price is $650. The estimated selling costs are $180. Net realizable value is $470. That is the selling price minus the selling costs. The replacement cost is $450, and we can expect a normal profit margin of $60. What are the per unit carrying values of Sony's inventory under IFRS and US GAAP? So let's first do IFRS. IFRS says that inventory must be lower of cost or net realizable value. So in this case, the cost is $500 and the net realizable value is $470. That means inventory must be carried at $470 or it will be written down to the extent of $30. So I will reduce my asset by $30. I will correspondingly in the income statement take an inventory write-off loss. Please remember, this comes above the profit before tax but below the EBIT of $30. under US GAAP, inventory is carried at lower of cost or market, and market is defined as the replacement cost. However, we need to check that the market is in between the net realizable value, which in this case is 470, and the net realizable value minus a normal profit margin, that is 410. So if it is in between these two values, then the replacement cost will be an acceptable value for the market, and inventory would be written down to this value. So in this case, the carrying value of the inventory will be written down to 450, and I will have an inventory write-off loss of $50. Please note the significance of the NRV. In case the replacement cost was not 450, let's say it was a value of 490. In that case, US GAAP would mandate that I still write down my inventory to a value of 470. So even though replacing it today costs 490, what I can realize from selling the inventory is only 470. Hence, it should be written down at least to the NRV. That is, the market always has to be between NRV and NRV minus a normal profit margin. If the replacement cost was not 450 or 490, rather it was a number of $400. In that case, I would not be allowed to write it down all the way till 400. I would only be able to write it down till 410, that is the NRV minus a normal profit margin. So even though replacement cost may be very low, I know that I can sell it today and realize a value of 410 even after deducting my profit margin. Hence, it cannot be written down to 400, it will be written down only till 410. So US GAAP is a more conservative approach as compared to the IFRS. So what if the value of the inventory goes up in subsequent years? Please remember that under IFRS, you can write the value back up only till original cost, not more than that. And in US GAAP, there are no write-ups allowed. So let's see. Assume that in the year after the write-down in the previous example, net realizable value and replacement cost both increased by $40. So net realizable value went up from 470 to $510, and the replacement cost went up to $500 from $450. What is the impact of recovery under IFRS and US GAAP? So under IFRS, we can take the value up back only till 500, not 510. So the inventory value would be 500, and I would recognize an inventory write-up gain on the income statement to the tune of $30, not 40. In US GAAP, I would do nothing. When I sell the inventory at whatever price, I will simply book a higher profit because my cost of inventory is low at $450. So some exceptions are sometimes allowed in the case of commodity-like products, wherein we can carry the inventory at fair value, which may be above the original cost, such as agricultural, mineral ore, and precious metals, where the inventory is carried at net realizable value and unrealized gains and losses are recognized in the income statement. So it's very rare, but sometimes we are allowed to carry the inventory at fair value. Now, apart from giving the inventory number, let's say whatever is the monetary value of the inventory, both IFRS and US GAAP require that we make certain additional disclosures. So you don't have to remember these disclosures. The slide is not very important, but just be aware that some qualitative information also needs to be given. For example, which method you were using, what is the total carrying value by classification, that is how much of the inventory is raw materials, work in progress, and finished goods. If any inventory has been reported at fair value rather than the cost method, the cost of goods sold during the period, any write-downs if there were, any reversals of write-down that were there, including why those write-ups were done, and the carrying value of any inventory that has been pledged as collateral to a bank or any institution. So please recall from the income statement that a change in the inventory cost flow method, for example from the LIFO to the FIFO or to the weighted average cost, is a change in accounting principle. And a change in accounting principle not only requires that year's statements to be restated, but also all prior years' statements that will need to be restated, assuming the new assumption or the new cost flow method. So the changes made retrospectively, that is the prior year's financial statements, are restated based on the new cost flow method. Under IFRS, the firm must demonstrate that the new assumption is better and why it will provide a more reliable and more relevant estimate of the income. Under US GAAP, similarly, the firm must explain why the change in cost flow method is preferable. So how well is the company managing its inventory can be judged from a variety of ratios. A popular ratio that we've already studied is the inventory turnover and the number of days of inventory. So ideally, we would want the inventory turnover to be high or the number of days of inventory to be low, so that less working capital is stuck or less capital is stuck in inventory and it doesn't require much funding. However, if the inventory turnover is high because we had to take a write down in the inventory, which is why the inventory number is low and it's looking like a high turnover, then it's not such a great thing. Like we studied earlier, a high inventory turnover means low funding, but firm may have an issue if there's a sudden spurt in sales or sudden excess demand for the product. A low inventory turnover would imply that a lot of capital is stuck in inventory. We sometimes also like to see the gross profit margin that the company is making. So this tells us if the company is actually able to realize a selling price which is higher than the cost of inventory, and to what extent. So if the gross profit margin is too low, then maybe the inventory is coming too expensive or the selling price is too low. So the LIFO reserve is an additional quantity that is required to be disclosed by companies following the LIFO method of accounting. So it is given to enhance comparability between the LIFO and the FIFO methods. The LIFO reserve is the number that must be added to the LIFO inventory to give us the FIFO inventory. That is, the firm that is following the LIFO method must also disclose the LIFO reserve, which tells that had the company been following the FIFO method of inventory right from the beginning, then the inventory would have been higher or lower to the extent of the LIFO reserve. So if I'm comparing two companies, one follows the FIFO method, the other follows the LIFO method, then the company that is following the LIFO method would also disclose the LIFO reserve that I can add to the inventory value of the second company and then compare the inventory levels of both for my analysis. So LIFO reserve, once again, is what needs to be added to the LIFO inventory to get the FIFO inventory. Now if you recall the cost of goods sold formula from the first slide, the FIFO cost of goods sold would be nothing but the beginning FIFO inventory plus the purchases minus the ending FIFO inventory. That's the formula for the cost of goods sold. We'll assume what we had in the beginning is sold first, plus what we purchased minus whatever we are unable to sell. Now we know that the beginning FIFO inventory is nothing but the beginning LIFO inventory plus the beginning LIFO reserve, and the ending FIFO inventory is nothing but the ending LIFO inventory plus the ending LIFO reserve. So if we substitute the inventory formula from the previous slide, we'll be able to easily derive that the FIFO cost of goods sold would be the same as the LIFO cost of goods sold minus the ending LIFO reserve minus the beginning LIFO reserve. See, most questions on these will be dealt with in level 2, so don't worry too much about the proof. Just know that it can easily be derived and remember this equation. Not a high likelihood of it being used in the exam, but useful to know nonetheless. So let's do a quick example and wind up the concept. Cyprus company, which uses LIFO, reported end of year inventory balance of $1,500 in 2011 and $1,700 in 2012. The LIFO reserve was $1,200 for 2011 and $1,300 for 2012. The cost of goods sold during 2012 was $4,000. Convert 2012 ending inventory and COGS on a FIFO basis. So the FIFO inventory would be the LIFO inventory, that is $1,700 in 2012, plus the ending LIFO reserve, that was $1,300. So companies using LIFO need to report the LIFO reserve, which when added to the LIFO inventory gives me FIFO inventory, which in this case is $3,000. Similarly, I can compute the FIFO cost of goods sold as nothing but the LIFO cost of goods sold, that is given to be 4,000, minus the ending LIFO reserve, that is 1,300, minus beginning LIFO reserve of 1,200. So the cost of goods sold would be 3,900 had the company followed the FIFO method. So that was about the review on inventories. We'll start next time with long-lived assets.